Hey everybody, this is Kansas Loan Man here, and today we're going to talk about down payment money and how it may be costing you more to put it down on a home. There are so many people I've talked about in a previous Mortgage Minute have money in the bank, or money in equity rather, that's going to be in the bank once they sell that home. They may have $100,000 available. If you've got a $300,000 house here in Wichita, Kansas, you might have bought that thing for a lot less in 2020, and you may have $100,000 in equity in that thing, maybe 60 to 100, but still, with the prices the way they went up, woo, it's possible you may have a nice chunk of equity in that thing. So let's talk about what it could do for you. Now, in the previous video, I talked about how $100,000 down on the house saves you $700 a month. Not a ton. But now let's talk about how it may be costing you. You put $100,000 down on a home, it saves you $700. Let's look at the rest of your finances. Do you have any credit card debt? How much is that costing you per month? On $10,000 of credit card debt, you're going to have at least a $250 payment, minimally. Probably a little bit more, actually. But let's say you've got great interest rate on your credit cards, which is compounding, by the way. So if it's 1 or 2%, it's still a lot more than you think. However, most credit cards, it's not like that. It's in the teens or in the 20s. So if you've got a $250 payment on a credit card just to make that minimum payment, which isn't going to pay it off, woo, that's gravy train. Because think about that. That means that $700 you're saving per month on $100,000, if you spent that on $30,000 of credit card debt to pay it off, you'd have $750 of savings a month. Wow. Think about that. Wow. You could create cash flow, not have to use those cards, not being charged interest anymore, raise your scores at the same time after that's done to get those things. When those things are closed out, I'm not telling you get rid of the cards, just manage them like an adult and don't charge them back up. Use them to build your credit instead, but lower those things to zero. You're going to save $750 in cash flow and still have $70,000 you could use put down on that house. Think about that. That means you're still going to be saving approximately $490 on your mortgage, plus the $750 you just saved by paying off your credit card debt. That's $1,200 basically in money a month that you just saved yourself just by changing what you're doing with your down payment money. I'm not a huge proponent of putting a ton of money down on a home when there's other things to be taken care of that are costing you more. How much is the interest on your cars? If you're looking at a 1 to 3 or 4% interest on your car loan, you're probably not paying enough interest to make it worth taking money from the home that you're selling to put and pay that off versus having it on the home itself, because cars are short-term debt. But looking at the long-term debt, looking at some bad debts, or what if you want to buy an investment property? You could use that money for that too. Instead of putting it on the main home and saving $700 a month, you could put it somewhere that could potentially create $200 to $400 to $500 to $600 a month in income as well. So then you're helping pay your house payment. We'll go over more financial things to do with money in the next Kansas Loan Man video. Just remember though, putting money on a house, if you're not set up financially, could cost you money versus saving you. Kansas Loan Man here. Listen in.